I want to start with this quote from Christian Kwalamagi, who I'm sure many of you guys know, fantastic swing trader. He's going to be featured in the next Market Wizards book, which I'm really excited to read his chapter. Episodic pivots, a setup I learned from Pradeep Bande of StockBee, has rewarded me several tens of millions in profits over the past couple years alone. The gapper setup is based on a stock gapping up on large volume with a catalyst. This setup is most effective when it occurs early in a strong uptrend, as later gappers may signal momentum deterioration and trigger institutional selling. This was the earnings gap where they kind of really affirmed the shift towards profitability and growth. A lot of their factories were ahead of schedule, models were being announced, and this created a 220% move from the HVC reclaim. And from here, Tesla never looked back. Basically, the gapper setup is a result of a significant imbalance in supply and demand after a large news catalyst that causes changes in positioning by large funds and players. Based on their models, funds need to start/add to positions, and the large number of shares they need to buy can't be completed in simply one session, and definitely not with just a market order. This is the end of day one. So this close of the last bar becomes the HVC. And then here we see the slight gap down and reclaim. And what I wanted to point out here is not only are we reclaiming the HVC right at this level, but look at this. We're reclaiming the anchored VWAP from day one, which again is a key level that traders are, being judged for their execution against. So as we reclaim that also adds fuel to the fire. And the anchored VWAP from day one often becomes a point that is retested on day two if there's initial weakness off the open. So day one, we'll talk about opening range breakouts, anchored VWAP test reclaims, intraday range breakouts. Day two, high volume close test/breakout, intraday range breakouts again. And then day three, the post gap range breakout, or the HVC retest/breakout. So let's dive in now to entry tactics. So we're kind of shifting gears from analyzing catalysts, getting stocks on your radar to now, okay, we want to trade day one, day two, day three. How do we go about actually doing it? Welcome everybody to the second of the Momentum Setups webinars. We already did a previous one on trading breakouts. Today, the focus is on trading another of the key momentum setup strategies, which is the gapper setup. This is whenever there's a key catalyst. This is most often an earnings gap, but it can be any kind of catalyst, a groundbreaking announcement that changes the prospects of a company. So we'll get into all the details here, a lot of the different types of gappers, and then a lot of the specific entry tactics that you can use to trade this setup while managing risk tightly. And I saw a few folks, this setup by its nature is extended. We're gapping up often out of a base, likely, hopefully into new highs. That adds fuel to the fire, but it can feel difficult to place a trade because everybody thinks that gaps fail, but it's the ones that don't that can make strong moves like this one, Sezzle last year, 150% move from the HVC. So that's what we're looking to capture here today. Here's a quick disclaimer. This session is for educational and informational purposes only. It's not investment advice. Make sure you do your own research and recognize that this is a high momentum setup and they often fail. And we'll actually talk through a case study of how I handled one recently last week. So make sure to do your own research, manage risk. This is a tough setup and take some time to get familiarity with, and you can read the rest of this at your own leisure. That being said, I want to start with this quote from Christian Kwalamagi, who I'm sure many of you guys know, fantastic swing trader. He's going to be featured in the next Market Wizards book, which I'm really excited to read his chapter. But this is one of the key setups that he trades. And he trades the variant called episodic pivots, which is developed by Pradeep Bande. But basically, here's what he said. Episodic pivots, a setup I learned from Pradeep Bande of StockBee, has rewarded me several tens of millions in profits over the past couple years alone. This is one of his key setups that he uses to trade. Me personally, I can't say it's contributed tens of millions just yet, but definitely tens of thousands. And it's one of the types of setups that when it's working is fantastic at moving the needle in your account. And, as I mentioned, a lot of people feel nervous about trading this setup because it feels extended. And that's almost precisely why it's so effective when it works, because there's a lot of folks who aren't trying this edge out yet, this setup out yet. And that's why it still is an edge in the market. So definitely we're studying this, getting some familiarity, and then trying it out and see if it works for you. And you don't have to try it with a full position at first. You can try it with 1 share, 5 shares, 10 shares to build that confidence and build the muscle memory. So you've got familiar with the setup, and then you can start to size up higher as you gain confidence in the setup. So I think this is a great quote to share because it just shows the potential of this setup, the episodic pivot. And a lot of what we're talking about, gapper setups applies. They're kind of looking at the same characteristic in the market. Episodic pivots has its own strict definition per Pradeep, but we're looking for that same, catalyst gap and how to profit and trade a trend from that move. All right, so here's the agenda today. First, we'll discuss, the gapper setup in general. We'll discuss how to screen for day one gaps, some key screens that I use from DeepView to help save me time and get me focused on the right ones to look at in the morning as well as during the post market. Then we'll talk about how to analyze earnings reports and catalysts quickly, because that's such a key part of the setup. And I've got a handy AI prompt that hopefully will save you guys a lot of time. And, it's something that I'm pretty proud of. I've just been tweaking it the past few weeks, and it's proved really effective of getting to the root of what an earnings report says from an important standpoint of what matters to contribute to these gaps. Then we'll discuss in detail day one entry setups, day one entry tactics, screening for day two gaps, day 2 and 3 entry tactics, day 3 and beyond entry tactics, sell rules, and then we'll talk about the case study of LMND, which I just recently traded, and how it didn't quite work out quite how I was expected, and some key takeaways from that trade for me personally. Then we'll close things out with some key reminders. And overall, this should be a lot of fun. And thanks you guys all for joining me here today. I think this will be fantastic. As we go, if you have any questions, leave them in the chat. And if you have any, things that you want to share from your own experience trading the setup, please share it in the chat as well. And if you haven't yet, go ahead and leave a like down below, subscribe if you're new to the channel, and let's go ahead and dive right in. So here are the key goals of the webinar. If I do at least a few of these things, then it's a success. First, we'll discuss the gapper setup and how to trade it with confidence. And again, with confidence is a key point here. Then I'll discuss and share a simple and repeatable process for identifying the best gapper setups day 1, 2, and beyond. Then we'll discuss that AI prompt to easily break down earnings reports and catalysts. And then we'll study a bunch of key examples, a lot of examples here today of both historic and recent gapper setups. So again, this should be a lot of fun. I love talking about setups, how to study them, how to build confidence in with them. And it can be the biggest, leverage point in improving your trading. So let's go ahead and dive right in. First, what is the gapper setup? Let's get on the same page with what we're talking about. The gapper setup is based on a stock gapping up on large volume with a catalyst. And this aligns closely with the high volume edges that we discuss in the Trader's Handbook, basically looking for the highest volume over the past year since the IPO week, or ideally the highest volume ever traded in the stock's history, and basically representing that there's significant interest from institutions, which is key to the setup being effective. This setup is most effective when it occurs early in a strong uptrend, as later gappers may signal momentum deterioration and trigger institutional selling. And this is because, just like we try to avoid trading late stage bases, later in a stock's move, there's more and more people who know about it. There's less people to actually aggressively build positions in a particular stock. So when there's a gap up late in a stock trend, maybe it's been trending for a few years, institutions who entered much early may use that as a point of, taking advantage of that liquidity and take profits on some of their position or all of their position. So this is really key here. It's best used early in a strong uptrend of both the stock and the market as a whole. Entry areas are identified after the gap using specific tactics and are considered most effective when the stock closes in the upper 50% of the daily range on day 1. So the daily range is basically, if you look at the low and high of the particular day, where is that close within that range? If it's over 50%, again, that's just showing that institutions are aggressively purchasing the stock and holding it close to highs. That's what we want to see ideally. It doesn't mean that if the gap up occurs and we close near the low, that the setup overall can't work, but it just is, a lesser of quality. That's it. Let's keep it simple. Earnings gaps can mark the beginning of strong trends and can accelerate a move. True market leaders often experience multiple earnings gaps during their moves. If you go back and study basically every market leader of the past, 5-10 years, you'll notice right away when you start looking for them, earnings gaps and gap ups just in general, off the lows of bases, out of bases, continuation gaps. These are just a hallmark of aggressive accumulation by institutions, and that's why this characteristic shows up again and again. This is key here. EPS, sales growth and surprises, margins improvements, and guidance improvements play key roles in leading to gaps and post-gap trends. And we'll talk about the reason why this is, but basically a lot of earnings gaps are created because the street and big institutions at large were caught off guard by the company. And based on that report, they basically have to re-rate and revalue a company and thus adjust their positioning in that stock. And that aggressive accumulation to adjust their position is what creates the gap up, as all those institutions, because it's often not just one, it's all of them fighting against each other. Basically, they're all fighting for those same shares, and they can't just go out and market order something. They have to buy on the gap up day. They have to buy consistently over the next few days and really few weeks and months to build to the size of positions that they need to once they recognize a seismic change in a company's prospects. And that consistent accumulation by institutions absorbs any supply coming to market and creates the post-gap drift, the post-gap trend that we're looking to capture as traders. Because it's really, that's what we're here for. We're trying to trade the continuation from the gap up day, because this can be a great opportunity to jump in, honestly, very early in a trend if you capture one of those early gap ups. And what's key here is, as I mentioned, this is a characteristic of market structure. If you go back and study market leaders in the past, this shows up again and again. And let me know in the chat. I've asked this question before, but what stock is this? If you don't know, if you already know, don't say in the chat. But if you haven't seen this before, let me know if you know what stock is on this chart. It should be one that all of you guys have studied. So let me know in the chat. I'd be curious to see if anybody can guess it. But basically, this is a characteristic of market structure, and this is created because of the Reg FD. I believe that was in 2000, where basically companies are no longer allowed to release information between earnings reports. And so all this, catalyst potential news comes out all at once in these quarterly earnings reports. And because of that, and this actually helps retail traders, institutions can't react to news as it's coming in. And instead, everybody's kind of on an even footing and reacting once that report comes out, once a conference call comes out. And so everybody is kind of, again, on an even footing and able to participate in a trend that comes up after this, any game-changing news. So this is a characteristic created by Reg FD that has basically created this gap or setup that we can profit from as traders. So it's kind of an example of how the dynamics that actually create the marketplace create a setup that we can take advantage of as retail traders. So this is, if people haven't guessed, I see one person has guessed it. All right, a few others. Cool. Yeah, this is Tesla back in 2019. This was the earnings gap where they kind of really affirms the shift towards profitability and growth. A lot of their factories were ahead of schedule, models were being announced, and this created a 220% move from the HVC reclaim. The HVC is, if you look at the gap up day, this is the high volume day. And then the close of that day is the HVC, the high volume close. And the next day, we reconfirm through that entry point, and we'll talk about that quite a bit today. This is just an early example. And from here, Tesla never looked back and went up 220% in just 68 days. Fantastic trend that hopefully we can catch as retail traders. Then, of course, it corrected in 2020, but then continued on and never retested this level and likely never will. So that's the power of buying these gap ups that kind of signal a shift in the direction of the company. And Palantir, we'll show that example later on, is kind of similar in this regard, where these gap ups start the longer term momentum trend. So if you can catch them early, whether you're a swing or position trader, this can help you, achieve better results. So here is an annotated chart from the Trader's Handbook of this exact gap. I discussed here a little bit about how the catalyst behind the gap is very important. And I mentioned here, the Tesla gap started its model book move from 2019 through 2021. The gap was on the highest volume in over a year. So a characteristic we're looking for, an edge we're looking for here. And not only was it the highest volume in 1 year, the first gap up day, but institutions came back the second day and pushed it higher on even higher volume. This just shows incredible demand. So if you see this, definitely pay attention and focus on that stock and look for an entry setup. So the gapper and these edges are things that should get the stock on your radar And then the entry tactics allow you to position at a point where you can manage risk tightly and logically and hopefully benefit from reconfirmation and a reinvigorated trend to the upside, like we saw here with Tesla. Here I add, Tesla had reported a surprise profit and that execution of its expansion of new factories and new vehicle models was ahead of schedule. Again, we're looking for things, or institutions rather, are looking for things that represent a seismic shift in the company and an indication of future profit growth. That's really what institutions care about. This earnings report indicated a key turning point and answer to this question. And the key question was, is Tesla able to be consistently profitable? And this earnings report kind of proved it in the minds of institutions that yes, it can be. And here is an example of the AI prompt, which I'll share and we'll go over in more detail in just a second. But it basically breaks down this earnings report, looks at earnings growth, EPS surprise, it beat on this versus a loss expected. So it reported a surprise profit. That's huge. Gigafactory ramp, I can't say that today. And TLDR, Tesla shocked with a profitable quarter driven by cost cuts and better factory efficiency despite year-over-year revenue decline. The Shanghai ramp and Model Y pull forward plus Solar Roof V3 framed a turning point narrative even as margins and sales were lower than a year ago. So again, this earnings report represented a turning point. That's what we're looking for in terms of the catalyst. Let's see now. This is another guess the earnings gap, and you can use maybe some clues. We've got dates down here. There likely have been some stock splits. So if you can guess this earnings report, I'll be very, very impressed. So in the chat right now, if you have an idea, let me know. Yeah, I know some people saw it, but don't. All right, I ruined it. Sorry, guys. I messed that up. But this is Nvidia back in 2016. And even though I spoiled it, it's still worth talking about. So here we've got another HVC reclaim. It never retested this level and went on a huge model book move. This was coming after a period, this wasn't uptrend before this, but really it was in a longer term basing period. Neglect. We're shortly after a base here. We have a gap up within the base, but this is really where it got going on earnings. Here is a little bit about what was said in the earnings report from the CEO. We are enjoying growth in all of our platforms: gaming, professional visualization, data center, and auto. Accelerating our growth is deep learning, a new computing model that uses GPU's massive computing power to learn artificial intelligence algorithms. Its adoption is sweeping one industry after another, driving demand for our GPUs. And I thought this was really interesting because back in 2016, Nvidia was already seeing that AI theme and leaning into it. And this just shows how long they've been in that game and why they were positioned so well here during the recent AI craze. But AI has been around for quite some time, and they were a leader even here. This quarter, 40% earnings growth year over year, beat on earnings, sales, new products. They had a GPU for Tesla to train their cars. The GTX 1080 was the big, I think that's a gaming chip. Guidance raise, that's key. Margin expansion. And I think this is really important. And this was what stood out to me. Nvidia said it entered into a 500 million accelerated share repurchase during the quarter and reiterated its plan to return about 1 billion to shareholders in fiscal year 17 via buybacks and dividends. So just like a beat in earnings and sales, we're looking for things that is going to change the dynamic about the stock, and decreasing the supply that's available to market is going to boost the stock price and contribute to trends. So whenever a company announces a share buyback during an earnings report, that's something to key in on. And that's something that the AI prompt can help you identify. And I'm not sure if I actually show that, but yeah, if you run the AI prompt on Nvidia, this earnings report, you'll see all this shown very quickly. And that's key, because in the morning, it's hard to focus on, identify which stock to focus on. And that AI prompt can really save you time and help you identify which names have game-changing catalysts. And from this point, Nvidia was up over 500% over the next 2 years, and a very strong model book move that you could have traded, recognizing the game-changingness, I'm coining that term, of this earnings gap. And this was the highest volume in 5 years. It was the highest volume in 1 year for sure, but really since, I believe that would have been 2011, this was huge volume. Again, signaling a shift by institutions. Whenever you see big volume, that's because institutions are involved. And when that's on a gap, that's when you want to pay attention. And we've got an HVC reclaim, another example of it right here, breaking through that high volume close. That would be the buy point if you're trading day 2. You could have also traded day 1 on this name, and we're off to the races. And it doesn't give you much of a chance to get in until later on. There are, of course, bases during the move, but we want to get positioned as effectively as we can. And look at this HVC reclaim. Look how tight the low of the day is to that level. That's what we're hoping for. We're looking for an ability to enter a strong recent earnings gap with a stop loss of under 3%, so we can get enough size to really move the needle if we get a strong trend that looks like this. And this just, to me, stands out in terms of institutional accumulation. Look how little it gives back during this move. It's like a frozen rope. And yes, it does pull back the 10 EMA here, but it just consistent buying and purchasing by those big institutions. That's what creates this price action trend that we see here. All right. So let's dive actually a little bit deeper into that. What creates large gaps and post gap trends that we can see and take advantage of as retail traders? Basically, the gapper setup is a result of a significant imbalance in supply and demand after a large news catalyst that causes changes in positioning by large funds and players. Based on their models, funds need to start/add to positions, and the large number of shares they need to buy can't be completed in simply one session, and definitely not with just a market order. They need to buy hundreds and thousands of shares. They have to buy, millions of shares, and they can't just do that in one day. That would take up all the volume and just push the stock price, to the moon. So basically what they have to do is use a variety of order types, IS, POV, anchored VWAP, market on close, to build positions over time. They have traders and desks and algorithms to execute this for them. And basically they have to have a consistent bid and just build their position whenever they can, whenever they've got a fair value price that they assess. Because again, they're not thinking in terms of a 20% move, 50% move, even, a move over the next few months. They're basically analyzing the earnings report and saying, this company is going to do much better 5 years from now, 10 years from now. This earnings report is just the beginning of that. So they don't care so much about cents and dollars at this point. They're just trying to get their position on. And basically they want to get the best price they can without impacting the market too much. And there's also other dynamics at play when there's a large gap up like that. So in addition to the institutions having to build positions, which really creates the big push, anyone who short the stock must buy the stock back to cover the position. That leads to share buys to cover their positions. Momentum traders like us join to position for trends. And also there's options exposure with options dealers when there's a big gap above the expected move. There's also other dynamics at play that lead to more share buying to neutralize exposure. So there's all these different factors in play in addition to the big institutions that basically add fuel to the fire and basically contribute to a stronger gap and stronger trend after the gap up. So this slide is basically talking about what creates the setup, because it is helpful to understand a little bit that dynamics in play, what's going on behind the scenes. And the key thing here is that institutions are adding to positions aggressively and are likely to continue to do so in the next days and weeks, leading to a trend that we can ride as retail traders. All right. So trading gapper playbook, I wanted to keep this as simple as I could. First, obviously, you have to regularly scan/identify stocks gapping up on significant catalysts. Then we need to analyze and judge, again, the term I'm coining, the game-changingness of the catalyst and the price and volume action. Then our job is to identify, as I mentioned, low risk entries day 1, 2, 3. And this is a momentum setup. Expect significant price moves quickly. And then our goal is, and our job is to manage the trade based on our sell rules. And I want to pause for just a second. In this webinar, we're going to talk about entries day 1 of the gap, day 2, 3, 3 and beyond. You don't need to trade all these entry tactics that I'm going to talk about. Some people are going to feel more comfortable waiting for a post-gap range breakout to form. That's honestly how I'm most comfortable trading these gaps. But some people might really enjoy getting involved day 1, trading that initial push. Maybe a day trader gets involved on that day and then revisits it later. These are just entry tactics that you can pick and choose and see what appeals most to you. But you 100% don't have to get involved day 1 at the earliest point to profit from a model book move that starts with the earnings gap, because there's going to be setups later on. There's going to be a post gap range breakout, a pullback to a moving average at some point. So don't feel a need to rush in and get in. You don't want to add pressure to yourself. This is the spot or I'm going to miss the stock. That's not true. And often when you think you've got a great entry, the stock will pull back and form maybe a better risk reward entry, maybe not a lower cost, but one that you can size up bigger. And size is really what creates performance when we're trading. So that's important to recognize. Is I'm going to talk about a lot of entry tactics. You don't have to master all of them. You don't have to trade all of them. Pick the ones and try out the ones and build your confidence slowly with the ones that appeal the most to you. All right. So let's get into the entry tactics we'll be covering from a high level. And we'll get more into detail into each of the days here. But first, day one off the open and variations, trying to position early on in the session, profit from a trend on day one, and hopefully the stock just takes off and goes without you. Goes without everybody else, and everybody else is chasing, and you've got a great position. You've got tight risk right near the low of the day or a higher low that happened, early in the session. That's the day one goal, is to position early on in the session and profit from that initial trend. Day 2 to 3 is when we're reconfirming that initial strength and breaking through the high volume close, breaking through the high of the gap up day. And basically there's been a very short amount of consolidation. Maybe there's this day 2 that consolidates this inside day, maybe not. Maybe it just goes day 2, but we're looking for immediate reconfirmation. Then day 3 and beyond, it's more of a traditional swing trade type entry where, you could use a post gap range breakout. You could use the high here as your pivot. You could use an oops reversal, some other entry tactic. Basically, day 3 and beyond, it's more like a traditional setup. And yes, it might feel extended because maybe the gap is, the base that's gapping up from is all the way down here. But again, you want to recognize that the supply and demand dynamics are at play, that this is likely to lead to a strong trend. So even though it might feel extended, you just kind of have to accept that and trade it accordingly. If you get stopped out, hey, that's trading. All right. So those are the 3 main types of entry tactics or types of days that we'll be talking about here in this webinar. And I see a question, what's the HVC? So HVC is the high volume close. So it's the close of the gap up day, because often these gap ups are on tremendous volume. That is a sign that institutions are involved. All right. Judging the catalyst. So let's dive deeper into this. So again, we've talked about this a little bit, but the types of catalysts could be earnings beat and raises, first quarter of profitability. That's a key one to look at. Guidance increases. This is a big one. Definitely pay attention whenever there's a guidance increase for that year or the next year. Significant new products / product news. Especially if the product is ahead of schedule, that can be big. Partnership announcements. We've seen a lot of recent gaps created because of OpenAI partnering with a company or Nvidia partnering with a company. That can create a strong surge that is tradable, especially if it's considered game changing and if the news is considered durable. So there's news catalysts that are more flash in the pan, one-time things. An endless upgrade to me is a lower graded or lower quality catalyst because it's not too significant, but there are catalysts that are game changing and again can change the course of the company over the next few years, and that's what we're kind of looking at. Regulatory changes that can create a gap up, index inclusions. Again, this is a lower quality catalyst for me, but it can work. For instance, we got Hood before the recent move. It gapped up on the S&P 500 inclusion and had a nice breakout from the base after that. And then also share buybacks. This is a key one that I look for. So guidance increases, share buybacks, always good to see. And then probably the most common reason for a gap is earnings beat and raise. So those are kind of the most common ones and can be very, very powerful, especially if the surprise is very big. For instance, if they're not supposed to be profitable in a quarter and they report a profit of $2 per share like Tesla did in 2019, that's something to really take note of. And again, I reemphasize here, the best catalysts represent a significant shift in a company's expected earnings and revenue growth and catch the market completely off guard. Those are the ones that are going to lead to big day one moves and ideally a trend after that day one. All right, so here's a little bit more into the AI prompts, and I'll email this out, so don't feel like you need to type this out completely, and you can try it out today. Basically what you do is replace ticker in brackets here with whatever stock that you want to analyze their earnings report. And if it's not the most recent earnings report, for instance, if you're going back and studying a lot of past earnings reports, for instance, the Nvidia one or Tesla one that we've referenced earlier, just say instead of most recent earnings report, the earnings report on May X 2019, whatever it is. So analyze ticker's most recent earnings report or whatever earnings report you want. Identify what stands out as important and significant. What did they say about revenue, earnings growth, margins, buybacks, new products and developments, or future guidance? Make each of these a section to cover and use 20 bullets total max. Also respond first with earnings growth year over year, earnings surprise versus estimates, sales growth year over year, sales surprise versus estimates, margins year over year, guidance changes, and then a 2-sentence TLDR of the earnings report. So again, the goal is to get a quick take on the earnings report. And this is an example with Frog, which had a strong gap up that John treated nicely on Friday. Analyze Frog's most recent earnings report, earnings growth up 47%, earnings surprise versus estimates, it beat by 6 cents. So again, you've got a beat going on. It also beat on sales, so it's a double beat. Margins improved about 1%. That's great. Non-GAAP margins up 18%. And up about 5.2%. Guidance changes, so they raised guidance. That's awesome. And basically TLDR, JFrog delivered a clean beat and raise quarter. And also, I think this is key here. It highlighted that there's new AI security offerings, signaling more platform expansion ahead. So again, institutions are looking for key announcements related to products that will increase revenue in the future. And that's a good example of this. So just in one quick snapshot, you get a quick take on the earnings report. So if you notice the stock in pre-market or post-market, copy down the ticker and just run this, and it'll give you an output like this, as well as more detail about the earnings and sales, breaking down the details, so you get that as well. But that's a quick way to review our recent earnings report. And if you're not using AI to help you as a trader, this is just an aside here, definitely start doing it. We'll be bringing more tools into DeepView to make this happen natively, but it can save you so much time and help get to the root of catalysts and so much else about a company that can really help you perform as a trader. So definitely try things out. Create your own prompts. You could upload your trading data and say, analyze trends. What setups are most effective for me? And if you're taking good data, which you should be in your journal, it can really help you identify your weaknesses as well as your strong points. So that's completely aside from the main topic, but definitely leverage AI to help you improve as a trader and be your own trading coach. I think that's really, really helpful. All right. So what stocks to focus on in general? So this is the Tigers acronym that we coined in the Trader's Handbook. We're basically looking for stocks that are involved in key leading themes, that are innovating, have strong growth, have strong edges, technical as well as otherwise, relative strength, and are forming a strong setup. So just as a step back, this is kind of the details. This is kind of in general the template that we're looking for, and it's kind of adapting CanSlim to modern markets where theme is really important and growth is really important as well. All right. So let's get into trading day one of a gapper. This is kind of the step-by-step checklist that we'll go through here. It might seem like there's a lot of text in here. Sorry about that, but these are just kind of the key things that I do to analyze and potentially trade day one of a gapper. First step is to identify promising gaps pre and post market. I'll show you the screens in just a second that I run. Then I analyze their catalyst, durability, and game-changingness of the catalyst that's causing the gap. Again, you can use the AI prompt to make that quick and easy, which is always awesome. Then we want to consider the stock's characteristics. Is it likely to make a significant move based on what you saw by analyzing the catalyst, as well as the shares in float? The lesser, the better, likely the bigger move it's going to make. A market cap, also the lesser, the bigger move it's likely going to make. ADR also, if that's larger, it's going to likely make a bigger move. Is it breaking through long-term resistance? Does it have the ability to make strong moves in the past? This is something I always like to see. Look back in recent as well as longer term trade history. Is there other instances of earnings reports leading to strong moves? Has it just been able to trend cleanly above the moving averages? This kind of gives you an insight about the character of a particular stock, and stocks have those characters and they're durable. So if it's able to make strong model book moves in the past, it might be starting one here with a strong earnings gap. Just in general, we're looking for gap ups from large bases, again, early in an uptrend, and ideally prior neglect. This is something I learned from Pradeep Bande. If it's been in a longer term downtrend that is now shifting to stage one and then gaps up on game-changing news, that can be a complete turnaround of the company. So prior neglect, either a gradual downtrend or just a stage one, as we'll see with Palantir in a later example. That's always key because it's just kind of an equilibrium. The stock's not really in the focus of anybody in the market. It's not overly owned at that point. So that's why a game-changing earnings report can create such a strong trend. Then also look at the volume of the gap up. Is it the highest volume in 1 year? You can look at run rate in real time in deep view, so you can get a sense of what the volume will be and how big the volume is. Anything over 1,000% is awesome when on day one for me. Then, once you've analyzed the opportunities in play that day, you really want to focus on one or two max, because this setup and entry tactics that I'm going to talk about do require intraday charts and careful attention and a lot of focus. So you can't really be trading 5 of these at once unless you're fantastic, and all power to you. And I really focus on one a day. I kind of pick, all right, this is going to be my shot for the day. And if the one I didn't pick, it goes without me, that's part of trading, right? And I'll kind of see in after the day's over, was there something I missed? Should I have focused on this one more because of maybe one of these characteristics? And just trying to improve over time, just trying to improve your process of elimination to make it faster, more effective over time. Then once you've got your top 1 or 2 ideas, prepare a game plan for trading day one. Think about what your expected or favored entry tactic is. How many shares are you likely going to buy, or percent of portfolio? Where would your anticipated stop be? And how much of your portfolio would you be risking with that percent anticipated stop and expected number of shares? Again, I'm trying to keep my stops under 3%. And for trading these gappers, probably about 10% position size of my portfolio, up to 25% of my portfolio is kind of what I'm comfortable with. So that's kind of the math that I've worked out. And I'm trying to risk less than 0.7% of my account on any one trade, because these can stop you out and then you might want to re-enter on another entry tactic. So honestly, I like less than 0.7% of my portfolio. Around 0.5 is kind of typically where I'm trying to be. And you can get there with decent size because a lot of the entries are pretty tight. Then once you've got your game plan and the market opens, it's all about just executing that. Then if you get positioned early and the stock starts making the move off the open, ride that intraday trend, following your plan with the mindset of whether this is a day trade or multi-day position. Some stocks, if you're not, if the fundamentals, if it's more of a flash in the pan, thematic gap up, and it's like a lower quality theme, like for instance, there's the theme of AI and stocks that, are building the semiconductors, that's durable. But if it's more of a company that nobody's really heard of and it's just being positioned in by Nvidia, that may be a lower quality gap. That might be more of a day trade, swing trade mindset versus one that you consider a potential true market leader move, and you might want to hold that on longer. So all I'm saying here is going into the trade, is this one I'm just trying to quickly flip, or do I want to really start a position from this point? And then manage the position per your plan. If you're selling some at targets, go ahead and do that. How you're adjusting stops, go ahead and do that. Are you selling at the close? If you don't have a certain price cushion, I like at least 2x my risk. Really 3x is ideal. So make that decision and know your plan going into the close, and then make any adjustments you need to do. All right. So let's get into the screens I use. So these are all presets in DFU, all I'm going to show. And basically what I've created is a pre-market and post-market earnings and gap up dashboard. So this is the pre-market one that I've got loaded. This is the pre-market movers and gap ups preset. And you know what? Let me just go ahead and show in DFU. Basically, this preset, you can find it by, let me X out, I don't want to change anything. You can find it by just going over to screen of presets, going down to pre and post market. And then this is the literal one that I use, is the preset one, pre-market movers and gap ups. And it's going to catch all the names that make big moves. Then what I do is, let me clear sorting, is I sort by 2 different things. I either sort by pre-market percent change, take a look quickly at those stocks. And then I also like to sort by pre-market volume versus the average 50 days. So this is a data point we've got in DFU. It basically looks at what is the pre-market volume and how does that compare to the average on a typical day. And if it's much bigger than normal, that's significant. And again, we're looking for institutional interest and involvement. And if institutions are involved, there's going to be big volume, and that's going to be obvious. So in pre-market, when I sort by this, I'm looking for pre-market volume versus average 50-day of over 10%. So over the normal, 10% of average volume is being traded in pre-market, which usually there's not much activity at all. So those names will get priority. So I look at a combination of the gap to see if it's significant. Over 10% is kind of preferred. And then also for this, over 10% pre-market volume versus average 50-day. So this is pre-market. So if there's any earnings reports before the open or any news announcements, they would show up here. If, for instance, it's if it's an earnings report, you want to use the post-market dashboard. So this is from, after 4 p.m., the market close, what stocks are reporting. This is where you would go. So very similar thing. And again, this is the preset post-market movers. I sort by post-market percent change, or I sort by post-market volume versus average. And for this post-market, because there's often a little bit more volume post-market than pre-market, I'm looking for over 30% of the post-market volume versus average. And again, post-market percent change, that gap, typically around 10% or more. A little bit higher is better, but too high, I often avoid, just because really big gaps often have a little bit more. One, they're likely stocks that are a lot more volatile, and I want volatile but not crazy volatile. And two, really big gaps, it's harder to make a day one move after a 200% gap than a 20% gap, depending on the stock and situation, of course. But I like 10% gap and over 30% average volume. So those are the two screens I use, and it's really easy to set up this dashboard. This is basically a screen element here, So I've got negative movers, so I see stuff that's gapping down too, and then a chart, so I can quickly go between names very easily. So those are the screens and setup that I use. So let's go back to the slides here. And I'll likely make a tutorial on how I set all this up so it's quick and easy. And we'll be able to share dashboards pretty soon too. So I'll just be able to drop a link. But yeah, I like to sort by pre-market percent change as well as pre-market volume. And then this is a good thing I pointed out. I like seeing, what sub-industry a stock is in. So I add that data point as a column and try to see if it's aligning with any themes that are currently in the market. For instance, Frog, system software, likely to do with AI as well. So that's a reason that caught my eye on Friday in pre-market. You've also got pre-market volume versus 50-day of over that 10% threshold. It's actually close to 30% here. And you've got a 20% gap, which is very strong. So this is why Frog, actually tweeted this out pre-market on Friday, why this one was kind of my preferred one here. I didn't trade this one, but this is kind of would have been my focus if I was trading this one. And it made a nice move here on day one. This is also from my Trade Lab report the day before. This was Frog showing up on the post-market because there's actually a post-market earnings gap. So I notified the Trade Lab members about this opportunity as well. Again, post-market volume versus average was well over that 30% threshold, close to 50%. So again, more of an indication that institutions are likely involved, that the catalyst is game-changing, and that it could lead to a strong day one move like it did. So that's kind of my routine and screens I use to keep track of these. So I had Frog, Figs, and Laser interesting for the next day based on the gap move as well as the volume there. All right. Here are some examples of just some more catalyst and strong day one moves. This was Reddit. I was involved from back in here. Strong gap here, really strong gap. I think this was up almost 50%, pretty close. Very strong move, and I added on that day. It was the first time it was profitable. So it reported net income of 29.9 million, revenue outperformance, and robust user growth, which is really critical for, of course, a social media stock. So that was the catalyst example for Reddit. You would see that in the quick. So this is applying that AI prompt to that Reddit gap here. So again, return to profit, earnings surprise beat by 39 cents, and surprise versus estimates for sales as well. Guidance improvements. And you can see here, TLDR, Reddit delivered a clean beat and raise in first GAAP profitable quarter, powered by surging ads, day licensing, and strong user growth. Quarter four guidance came in ahead of consensus, reinforcing momentum into year end. So a game-changing report there. Here's another example, another one I was involved with. A-Lab, here we had a gap up on an analyst raise, which I don't really like, but then later on we had an earnings gap. I got involved in here and later on the post gap range breakout. Strong surprise in earnings. And looking at that AI prompt, you can see the quick breakdown here. A-Lab delivered a beat and raise inaugural fall print, triple-digit sales growth, strong margins, and upside Q4 guidance. Again, an increase in guidance, that's key. And then I really like this one. New Scorpio AI fabric switches plus broad product ramps were the standout growth drivers. So we're seeing new developments, new products making an impact. That's what institutions care about. So that's where this prompt comes in handy at highlighting that from that A-Lab earnings report. Here's the Palantir. So again, this is the example where it was stage one. It was kind of consolidating after declining for quite some time. It had a very strong IPO move. So again, that's an edge. We noticed that Palantir is able to make a strong move. Then it had a normal consolidation period after its IPO, entered stage one, and then this was a gap up from that stage one, where it was the first time that was gap profitable, and also announced some AI announcements. So here, TLDR, Palantir's May report beat on both lines and marked a second straight gap profitable quarter. So it's showing to institutions it's turning that quarter. And the debut of its artificial intelligence platform plus guidance for profit every quarter in 2023 set a more durable AI-driven narrative. Also, I believe this was share buybacks, might have been a little bit later, but it announced that shortly thereafter and continued on with its move. You've got margins improvement as well. And again, that guidance improving as well. Actually, one more thing. This was key. When you see this type of language, it said it was expecting to be profitable every quarter in 2023. That is like gold to institutions' ears. When they see that a stock is turning the corner with their quarterly reports, and it's showing with certainty, it's saying with certainty, we're going to be gap profitable from here on out. That's what they're looking for, and gives them confidence to build and increase positions in the particular stock. All right. So we've talked a lot about analyzing catalyst, trading day one. Here's just kind of a step back again to the different entry tactics we might use for different days. So day one, we'll talk about opening range breakouts, anchor VWAP test reclaims, intraday range breakouts. Day two, high volume close test / breakout, intraday range breakouts again. And then day three, the post gap range breakout or the HVC retest / breakout. So let's dive in now to entry tactics. So we're kind of shifting gears from analyzing catalysts, getting stocks on your radar to now, okay, we want to trade day one, day two, day three. How do we go about actually doing it? And before we do that, let me see if there's any questions here that I've answered. Let's see here. Cool. All right, I don't see anything too much, so let's keep on going here. So getting into the entry tactics, let's talk about day one first. There's three main variations that I like to use. And again, you don't have to master all of these. Some of these are going to appeal more to you. Some of them might not appeal at all. For the first one is an opening range breakout. Basically, the stock opens, sets a key high, and then breaks through that high early in the AM. This could be a 5-minute chart. This could be a 1-minute chart. This could be a 3-minute chart. So each of these bars could be, that time frame. But basically, we set a high and then break through that, and that would be your entry. I personally don't like this one because it feels a little bit short-term extended to me. I prefer buying within the base when there's an anchored VWAP reclaim, which is often a little bit lower, and setting my stop here. So that's the second variation, is when we reclaim the anchored VWAP. And the anchored VWAP is the volume-weighted average price anchored to the open of that day. So the volume-weighted average price is often used in a lot of algorithms by institutions because it's kind of that fair value, fair price that they can purchase. So when the stock price is below it, they're kind of improving their cost or improving their execution if they build a lot of position before that and the stock eventually pushes higher. And it's just kind of a clear line in the sand of who's in charge on that day. Are bulls in charge if we're trending above it, or are bears in charge if we're trending below it? So when we reclaim that and the bulls take charge, all the institutions are trying to get their shares right at this point as we break up through it. And their traders are basically graded on their execution. How closely on that day are they able to get to the average volume weighted average price? So there's often a lot of activity. It will be support on a retest, but as we push through it, that's when I like to get involved with the anchored VWAP here. So it's kind of a function of the algorithms that institutions use to execute and traders use to execute. And this often happens after maybe the stock pushes up, begins declining, and then reclaims. Or maybe we just pull back off the entry, form a range, and then reclaim it that way. There can be several variations, and we'll see a bunch of examples in just a minute of the anchored VWAP reclaim. The other tactic might happen later on. Maybe the opening range breakout is, maybe this is it right here. Then later on, just a more standard base, obviously on an intraday chart, happens. And then we get a classic range breakout or base breakout on that time frame, setting your stop at the higher low. That can be another way to execute if you weren't able to position or just want to add a little bit to your position after, being positioned from, earlier or down lower. But all of these day one entry tactics, I much prefer when it's shortly after the open. And again, the reason being is I want to profit from that expansion on day one if it happens and get a good cost, get a good cushion so I can, hold through day 2, day 3 and beyond. So again, I prefer when these happen shortly after the open. These ones almost always do. This might happen and give a good opportunity later, but I prefer when all of these happen closer to the opening price. All right, so day one gapper entry tactics. Here's just a quick thing that I want to mention here. First, focus on 1 or 2 names. I mentioned this already. These require fast execution and focus. Again, you might watch this webinar and decide gapper setups are not for me because they require, positioning, in fast moving names that, often require intraday charts. So just, be honest with yourself and your trading abilities. If you're new to trading, this is probably more advanced than a breakout trade. So know your domain of competence and where you are along your journey. And maybe you just take a note of this, watch this webinar, 5 years down the line. And then at that point, you're ready to, master this setup. So just wanted to say that. It's often helpful to have an order prepped with your broker and just need to kind of click confirm. That helps with improving your execution here. I prefer the first 1 to 3 anchored VWAP reclaims, intraday anchored VWAP reclaims. I really prefer the first one or second one. And my typical stop is the low of the day on those or the higher low within the opening range. I don't want to get too tight because intraday we can shake quickly. But I want to, be protected if the stock is breaking lower instead of continuing higher from the anchor VWAP reclaim. So I mentioned here, I try to avoid too tight stops within the opening range because there often are quick shakes and it might reclaim the anchored VWAP, fail it, and then reclaim it the next bar. I don't want to get shaken out on something like that, but I do want to get shaken out and stopped out and protected if it actually starts breaking down instead of pushing higher from the anchor VWAP reclaim. I try a position with stops less than 3% risk and have a profit cushion of 2x my risk, at least to hold the stock through to day 2, ideally 3x or more. So if I'm taking a 2.5% stop, I want at least a 5% cushion and ideally a 7.5, 10% is even better cushion to hold through future days and hold overnight after day 1. And then here I bold this because it's important. I want to position very early in the session and benefit from a strong trend throughout the day as institutions push the stock higher. I want them to do the heavy work after I've got my position set and just allow them to push it higher. And then that's just more cushion on my plate and makes managing the stock that much easier. And then this is really key. This is just an observation. The best gappers trend all day above anchor VWAP day 1. And that's because institutions are fighting themselves for the best price. They're just trying to get positioned. And the stock is not even dipping below the anchored VWAP. It's just so strong that it just trends all day. And you've probably seen this, a stock that just goes up, it gaps at 20% and then continues higher 20%, without really pulling back much intraday and closing right near highs. That's because institutions really want that stock and are just telling their traders to go ahead and position at whatever price they can. So this is really key here. All right. So here's an example. This is a daily chart of BE. They had a catalyst announcement with a partnership with Oracle, breaking out of a big base. This was, I think, at least 3 or 4 month base. And this is a strong gap up, big volume here. And then this is the day 1 that we're going to be looking at on an intraday chart. We also get a high volume close retest later on, but we're going to be focusing on trading day 1 here. So here's a 1 minute chart. So again, intraday chart, this requires quick fingers and quick reactions. Here we have an initial move lower on minute 1, and then minute 2, we break through that high and the anchored VWAP. And this bar, if you think about it, pulled the volume weighted average price higher because it closed up here on very big volume. So the anchored VWAP reclaim was more, here or here, coinciding with that orb. So this would be where you position on that first very fast anchored VWAP reclaim. But if you weren't able to catch that, that's no big deal. There's often, another one or another one after that. Here's a second, we dip below it, reclaim. So we're seeing a bid as we reclaim the anchored VWAP, and as we dip below it, it immediately gets bought up. That's a good sign. That's telling you institutions are involved. Then we get more of a basing process, and this is kind of setting the opening range. And we have a few more dips below the anchored VWAP before we eventually push out and trend the rest of the day. So we have a few more opportunities if you didn't get positioned here or here to trade this. And here the stop would likely be low of the day. This one also low of the day. It either works or it doesn't. And then here I would use more this low of the day, or here if it's less than 3%, because I don't want to get shaken out. And I acknowledge it's forming a base here. This is kind of the low of that intraday base. And then this one, I'd also probably set my stop here or here if it's within 3%, because I don't want it to just shake below and then push higher without me. So that's BE. Here's CRS, another recent move. This was a catalyst gap on earnings. And let's dive into the intraday chart. So this is a 3-minute chart here. We push strongly off the open. If you weren't positioned, it just went without you. But then we get a dip and reclaim of the anchor VWAP. This would be where I'd want to position. Setting my stop likely at this low, unless this is within 3%. And we just trend nicely the rest of the day. We do have a little bit of a base, and then it closes strong. But this basically, there's no heat. There's no test of your cost if you get positioned correctly at the anchor VWAP. And you've got 9% cushion end of day, which is enough to hold through and profit from potential continued trend as we are holding the 10 EMA and push higher, and we get a little bit of a retest of HVC later on. So these HVC aren't just important the first day, they're points of support later on in the trend if we do pull back into them. And here you've got confluence of the HVC with the 10 EMA. And again, the HVC, just for people who have never heard this concept before this webinar, the HVC is the closing price, so the close of the first bar that gapped up on high volume. That's why it's called the high volume close, the HVC. All right. Here's another example. We've got Okta, 3-minute chart. You've got the anchor VWAP reclaim, basically bar number 2, and then an opening range breakout here. Risk to the low of the day is 2.75%, so you're able to do that. The anchor VWAP risk to the low of the day is even less than that. Both of those would have positioned you really nicely. We push higher, and then base intraday. This would be a potential intraday base breakout opportunity, or here up the right hand side as we break through this pivot. But these would have been better entries. And with these, you really want to get positioned early and just get that set and let the stock do the heavy lifting. I much prefer these entries versus later on, because you have less time for the stock to expand from your entry. If you're trading an intraday base breakout later on, maybe at 11 a.m., 12 p.m., 1 p.m., you have less time to get away as far as possible from your cost basis to hold back. Because these gap ups, the next day, it's fully within its right to consolidate. So if you think about it, if you bought an intraday base breakout, even if your risk reward was awesome on this day, you're not really going to be able to handle a pullback to your cost and all of that. It's much better to have more cushion by entering closer to here, so you can handle a normal inside day, and then you stick with the stock later on. So I just want to make that clear why I prefer early entries versus a later intraday base breakout. Here's one with Tesla on a 5-minute chart. We have an aggressive 5-minute opening range breakout here. Then we have an opening range set here. We've got the risk to the higher low, which is this low here of 0.7%. So under 1%, that's fantastic. And then we also have an anchor VWAP reclaim right here. And you can either set your stop right here to be very tight and it either works or it doesn't. Or if you want to give it a little bit more room, set your stop here. I think that would be under 2% actually, buying here on the bar that as it's pushing through the anchor VWAP, that's where I like to position. Again, you might find something else works better, waiting for a close. It depends on your style, but I would be buying here and setting my stop here, or likely at the low of the bar. It either works or it doesn't. I've got very tight risk if it doesn't. Here is Coinbase, another opening range here. Here's the anchor VWAP reclaim right here. Early entry through this level here. So you can kind of trade this as any base, but again, it's going to be intraday candles, so it's going to be happening a lot faster. And then you have the opening range breakout. Risk to this higher low is 3.5%. So a little bit bigger than I like, but you can still trade that and simply size down. If you were going to look to use a 15% position, you could use a 10% position and still keep your risk within your parameters. And notice how strongly this trended after this opening range breakout and just all day above that anchored VWAP. This is a great example of that. Here is SMCI. This is the big gap up. I think they pre-announced their earnings report and it was very strong. And this is the trade that made a lot of top traders years in whether that's 2023 or 2024, I can't quite remember. But this made a lot of traders years. And it was a super strong one. And you had to act quick if you're going to trade the 1 minute orb. If you waited for a 3 minute, 5 minute, you were left in the dust. And this just trended all day above that anchor VWAP. And you've got the anchor VWAP reclaim a little bit earlier. And then the 1 minute orb risk to the low of the day is 3%. So again, within the risk parameters that we've set. Here is ASTS. This was the big gap. I think it was on an announcement either with Verizon partnership or announcement or maybe T-Mobile. That was the catalyst here. We get a gap up and then immediately consolidate. We've got a tight range and an early entry here maybe. Anchor VWAP reclaim here never really gets tested. And we trend beautifully. And this went on like 5,000 or 10,000% move, something crazy after this gap up here. And here's the opening range breakout. Stop to the higher low again is bigger than we'd like, 5%. But again, you can size down. And in a name like this with very low price at this point too, you probably wouldn't want to be putting on a 20% position anyway. It's just a little bit of more of a, not maybe lower quality, but more just more performance enhancer type name versus a true market leader quality name. You know, if it's such a good stock, why is it $3, right? So I'm more comfortable sizing up bigger on names that are trading $200, $100, $500, because they're more liquid and institutions are more likely involved. So that's ASTS. This is just a graphic of the intraday base. So again, we get a push off the open base, and then you can enter through the base pivot or maybe an early cheat entry, setting your stop at that higher low. Here's an example with Tempest AI. We have a catalyst gap here, pushes higher, and then we've got a range breakout here and the actual base breakout here, and then we continue trending into the end of the day. Here's an example with ELF. We have a big move off the open and then it just consolidates, tightens, and bases. Here is the base breakout here through that line of resistance. So you're just looking for a clean line, just like you would on a daily chart. Set your stop at the higher low here or here, less than 1% risk. And at close, you're up about 3R and you're able to hold through to the next day. Here's Bloom Energy. In this example, we sold off the open. And so it's a little bit different. We've got an anchor VWAP reclaim, setting your stop here at the low of the day or this higher low. And then we've got an intraday base breakout here. You can see the basing structure and live resistance that lines up with the anchored VWAP reclaim, and risk to this higher low was 2.75%. So it's within the risk parameters. So you can kind of see the entry points that we're identifying here. Here's a graphic of the anchored VWAP reclaim, because not only can it happen shortly off the open, but also it can happen later on. Again, the anchored VWAP is a clear, it's a really important level for all the algorithms and traders that are trading for the institutions. And often if we retest the anchored VWAP, it can undercut and reclaim and be a really awesome opportunity, because as we push back through, all those traders are fighting for the shares at that cost so that they can look good in terms of their execution for that day and putting on that position. So often if we get an undercut and reclaim intraday of the anchored VWAP, that can be a really good entry point. Here's an example off the open here with Unity. We've got opening range that gets set here, but you can see the better opportunity is here through the anchor VWAP reclaim versus through the pivot. You're just a little bit less short-term extended on a very short-term basis, because again, this is intraday charts, and you got a nice trend into the end of the day. Here is Coinbase, another example of coin where this is pretty common. You get a push higher, short range, short undercut and rally of the anchor VWAP, and then trend the rest of the day. So again, stop just under the anchor VWAP, could be 1.5% if you're using this high as the buy. If you're buying versus, as it pushes through the reclaim, you could use the low of the day as your stop as well. And as I'm going through this, you can see you have to be a little bit creative with your stop loss, with your entry point, and find what works for you in the moment and in the particular stock. So here is an example with QBTS, recently more of a flash in the pan theme. Pushes higher, and then we get an undercut and reclaim of that anchor VWAP. So this is like an example of later on in the day, and we find a bid there and push higher into the close. And the gain end of day is 11%, and low of the bar here is risking about 2%, and this is a little bit more as well. Here's an example as well. We get the reclaim right here, and then we get a base against the anchored VWAP. You see this pretty often in a name that just isn't trending super strong, but you want to see respect for the anchored VWAP. That's kind of the key thing I want to pass on to you guys. You want to see respect for that level, quick reclaims, and pushes off of it once we do reclaim it. And you can see a few opportunities here with this name here. All right, so that is trading day one. So again, the three things: opening range breakout, anchored VWAP reclaim, or intraday base. And we want to enter as close to that opening price as possible. So let's go ahead now and push on to trading day 2 to 3 of a potential move. So we've got day 1 already in the books. How do we join on to the trend if we're not already involved on day 1? And again, it's completely fine to not get involved in day 1. There's many low risk entry tactics that you can use, and we're going to talk about them in just a second. But kind of the next one we're going to focus on is either we get maybe a pause day 2, a tight day, inside day down here, and then we push through that high volume close, that clear level that institutions decide this is where we're going to close. We're going to decide to close the stock at this level. This is a very key level, and you can buy the reclaim of that. And likely, if there's going to be a strong momentum push, we're going to reclaim that level and just go. This can also happen just on day 2, where you get a strong day 1, and then the next day, ideally we gap down and we push higher. And I say ideally because in this circumstance, it's really easy to manage risk right at the low of the day. This one as well, you can manage risk right here at the low of the day or the low of the previous day. But basically you want to manage risk again within kind of that 3% range is typically how I like to approach things. Alternatively, just like day 1, you could use an intraday base breakout. If we are consolidating intraday and then push higher, maybe we're a little bit below the HVC and you're kind of anticipating that breakout. You buy as we push through an intraday base as we get towards that level and get the participation of anybody who's buying through the HVC after that intraday range breakout. So these are the main ones we'll discuss for day 2 to 3. Here is Sezzle. This was again 150% move from this HVC reclaim. You can see we got a slight gap down below the HVC and then strong push off that open through the HVC. So really good entry point. Set your stop at the low of the day and just benefit, and you get a strong cushion end of the day. We're still looking for a really good cushion because again, we want to be able to absorb any consolidation after this push. So we want good cushion, 2 to 3x our initial risk. And here is the intraday view on a 5-minute of that push through HVC. So again, this is a 5-minute chart. This is the end of day 1. So this close of the last bar becomes the HVC. And then here we see the slight gap down and reclaim. And what I wanted to point out here is not only are we reclaiming the HVC right at this level, but look at this. We're reclaiming the anchored VWAP from day 1, which again is a key level that traders are, being judged for the execution against. So as we reclaim that also adds fuel to the fire. And the anchored VWAP from day 1 often becomes a point that is retested on day 2 if there's initial weakness off the open. And often a stock will pull back in quickly and then recover and then go. So watch for a pullback into the anchored VWAP from day 1. I like to leave it on my charts until maybe day 3 and beyond because it also often becomes, as I mentioned, a key level that can be reclaimed or retested. And we push higher from this point. And again, Sezzle up 150% from this buy point right here. And again, we're looking at intraday charts here because these movements are quick, but we're only looking at intraday charts because on a daily chart, a higher time frame, and even on a weekly chart, because this is a big base, there's something special going on. We're not looking at an intraday chart at random for no reason. We're looking because something significant is happening that we've studied and is an indication of a potential strong trend that we can profit from as traders. And we're using intraday charts for execution to manage risk because we're trying to get in on a daily/weekly setup. That's really key. We're not looking at an intraday chart at random here. We're looking at key levels from a daily chart and seeing how stock respects or doesn't respect those on intraday timeframes. Here is that Tesla 2019 HVC entry again through that close. We got a nice gap up and push through. Manage risk at the low of the day of this day 2. And we're off to the races, and this level has never been retested. Your stop was never hit if you kept it here. And of course, there were post-gap range breakouts as well, but then we're talking really about day 2 entries here at this point. Here's DocuSign. This is an interesting one. We get, I think this is a 2019 gap. I'm not quite sure, but we get a strong day 2 push, and then we gap right back down to the HVC and push again. So it was kind of like you got a redo. You get 2 shots at this, and it never took out your stop here at the low of the day, but maybe it gave you another opportunity to add or start a new position this day 3, because we got basically the same setup twice. It's like, I don't know quite what happened here. I don't know if there was news on the gap down and just bought it up, but this was interesting to me. And from here, DocuSign went on a really strong move, set up a cup and handle that I traded back in 2020, was one of the big winners of the COVID times. Here's ELF, and here I wanted to point out the power of the HVC, because often, and if you bring up a chart of ELF and just draw the HVCs across, as I did here, it's amazing how pullbacks later in the trend, and typically they're not as late as this. This is like a few months down the line, a few weeks. Often they're like shortly after it, we get a pullback in the HVC, but they are key spots to trade pullbacks. And you want to see respect for it, push higher, and then use your typical pullback type setups to enter. But it's amazing ELF during this move. It had many times where it retested the HVC weeks later and then took off and continued on with its trend. So definitely bring up an ELF chart and study this. It's amazing. It's just a great example here of HVC pullback. It did this like every gap. It pushed higher, retested it, and then pushed higher again. All right. I see a question from Bobster. How big in percentage should the gap up be? I like seeing at least 10%, but this could be a 5% gap at the open and then push higher further. But I want to see probably at least a 10% at the close here to look to trade day 2. You want to see momentum here. All right. So here's ASTS. So this is more typical of an HVC retest. We get initial momentum for a few days, retest it. That's where it finds support. This would be a buy point, or the next day as it pushes off of that level. And then we're off to the races, and this set up high tight flags and an amazing move as we talked about here. And it even had another gap up because of another partnership announcement, and had basically an HVC reclaim here later on that you could have traded to. But we're really focusing on this first gap up, pull back into the HVC, that clear level, and push higher from that point. So again, another concept I want to make sure is important to you guys, and something that you should study on your own, is draw a line at high volume closes, and the higher volume, the better. Ideally, it's highest volume in a year or ever, and see if how stocks act versus that level, and see how they respect it and how it can present a great entry opportunity, either on a reclaim on that level or a retest and bounce from that level. Here is Root, another great episodic pivot and catalyst gap on earnings. I think they reported revenue that was like a multiple of their market capitalization. So that's what led to this amazing move here. And this also was a base breakout. And what I'm pointing out here is, instead of a move through HVC here, we get a move through the earnings gap high. It gapped up and pushed higher through the base breakout day 2. So this could be a variation. Again, you have to be a little bit creative. The key thing is that you want to be able to manage risk. That's the key thing on your entry. And you could still manage risk really nicely, either at the low of the day on day 2 or at the HVC or just under the HVC, because often stocks will gap up slightly above the HVC, retest it, and then reclaim it and push higher, and then that's when they go on day 2. So often just below HVC is a good point to set your stop loss on a push higher from a bounce off the HVC. But this is a really nice move, another great one to study that will be in the model book. All right, so that's kind of day 2. Again, we're looking for reconfirmation. So day 2 or 3, maybe there's an inside day, maybe there isn't, but we're looking for quick reconfirmation. So institutions are really interested in the stock and want to keep building their position aggressively. That's what causes reconfirmation after the initial strength of the gap. So day 3 and beyond entry tactics are more standard swing trading type setups, because we've got an initial sign to focus on the stock, which is the big gap, but we haven't had reconfirmation. We've consolidated a little bit for at least a few days. So there's a few variations that I point out here. First, we can have a breakout through the HVC. We saw some examples of this. You can see a failed day 2, and that happens 100%. We pull back, consolidate, start U-turning, and then this would be that buy point through that high volume close level, and then we're off to the races. Another variation of this is maybe we sell off the open on the gap up day, but then just form a tight range. and that can be tradable here. AMD did this from this recent gap. That could be one to take a look at. You're looking for highs to line up, entering through the range breakout here, setting your stop at the low of the day day before, or if you like it a little bit wider, this low here. And you don't want to see it dip below the low of the gap up day too much. That's a sign of weakness. We want to see that weakness, any selling after the gap up, is being absorbed. And that's what this upside reversal shows. And then we hold here, form this range, and reconfirm higher. That's our entry stop low of the day or the day before. Then we can also have initial strength and then pull back to the HVC, slight undercut, or just pull back to that area and then reconfirmation. You could enter here or through this high as we reconfirm this upside reversal. So that would be kind of an HVC bounce entry after the pullback. And set your stop below the day here if you're entering this bar, or here you could set your stop easily below the day, buying through that bar's high. So this is the kind of 3 variations to look for day 3 or more. And sometimes, and I do want to mention this, sometimes there's a big gap and then the stock just rebases and consolidates for 3 weeks, 4 weeks, 5 weeks, and then breaks out. So I always like to track recent gaps, and I keep a watch list of recent gaps, because even if it doesn't trigger a day 1, day 2, day 3, day 10 entry, it can still be a tremendous stock that has everything going for it. It just needed to consolidate a little bit more and absorb a little bit more supply with that base before it is ready to make a move. So don't take recent gaps that were really strong on good catalysts off your radar, because there can be entry tactics early on or later on after a full base, or maybe you don't trade the initial move after the gap, but you trade the base after that. So it's always good to see this, because these are stocks that are showing something special, showing institutions are involved. All right, here's Intel. This is a recent example of a range breakout. We have a catalyst with an Nvidia investment, strong gap up. This stock has been neglected for like a decade. I don't know how long. It's been a dog of a stock, but recently it's woken up a little bit with kind of this news here, and that's what the best catalysts do. They wake up the stock. We initially pull in, form this range with this highs, and then this is the post gap range breakout. And I think you're up about 25% from that point. And we're still in a trend. It's holding up much better than the market, but we'll have to see what happens with this name here. If the market continues to pull in, it might need to form a whole new base here versus the 50 SMA. But regardless, this is a good single trade, even if you're a swing trader trading this, if you're a day trader, trading this move, or if you're a position trader just starting a position, you've got a good cost basis from this entry. So it's good regardless of your time frame or style. That's kind of why you want to kind of learn all these different entry tactics. Here's ASTS. We take a look at this earlier. We've got initial gap up, pulls back in, holds above the earnings gap low, tries to break down but fails. A failed breakdown often leads to a move the other way. We get a gap up, retest of that, push higher, and then this is the post gap range breakout I added to my position here, and also on this bar here off the 10 EMA pullback. And this is a good example of the post gap range breakout happening a little bit later after the gap up here. Here's one with Reddit. I also traded this one, strong gap up, pullback, tight flag. Again, a bar that tries to break down, but then the next day refuses to reconfirm lower, gaps up and pushes through that high, and that's the entry point. Say you're stopped at the low of the day or this low, and we're off to the races. And here's another further one on the 10 EMA. So after a gap up, keep an eye on that 10 EMA. You want to see the stock respect it, and often there can be pullback entries versus that 10 EMA later on in the move. You can see it respected the 10 EMA throughout this entire run. Here is TEM. You need to kind of position a little bit here, range breakout or an oops reversal. Again, got to be a little bit creative. But basically, after a gap, try to work your way into a stock that has everything going for it and looks really promising. And that can be a range breakout. That can be an oops reversal. Be creative with these post-gap entry tactics. Here is Tesla back in, not 2019, I think 2013, potentially. It announced its first ever quarterly profit. This was a big base. I think a year or more. And then this went on a model book move from this post-gap range breakout and trended well above the 10 EMA and 21 EMA for basically the majority of that move. So again, we initially gapped up, but didn't reconfirm higher. Instead, we pulled back, held the 10 EMA, tightened up. We're looking for that range tightening. Look at volume lower as we're building this range. This becomes the pivot. And then this is your buy point, this bar right here, as it breaks through that level and setting your stop at the low of the day, or the 10 EMA would also be a tight and logical stop here. and then we hold the 10 EMA as we go. Here's an annotation of that 2019. So again, this is the 2013 gap, I believe. And correct me if I'm wrong. But this is the 2019 version, which also set up some post-gap range breakouts here during this area, as well as we had a gap down. This is always interesting to see how kind of news events collide with the price action. We had a gap down because of the Cybertruck news, and then everyone's like, no, that's fine. Tesla is still going to do well. We hold that 21 EMA, form this range, and then we get another range breakout entry, which gives you a great cost to benefit from this trend. And I love how it respects the 21 EMA and forms tight price action during this pullback. It absorbed this gap down really, really well. So just want to point that out and show these post-gap range breakouts because this one is kind of a great example to study in Tesla in general. You should go back basically bar by bar from its beginning and study its move because it's had so many great, powerful moves. But this one showed a day one entry. It showed a day two entry. It showed a post-gap range breakout here. After some basing, a longer term consolidation, we have another range breakout. So it just goes to show that the gapper is almost the edge that gets it on your radar. And then you want to be creative in terms of how you position it after you've identified that the catalyst that caused the gap is more durable and something that institutions will aggressively want to build their positions in the stock because of. So again, this is the edge, and then the entry tactics are how you're creatively positioning in the stock while managing risk. All right, so sell rules for gappers. Keep it pretty simple. I use faster rules if entering day 1, 2, or 3, depending on if it's something I think I'm going to be more position trading versus swing trading. As I mentioned before, I want to have about 2 to 3 R to hold through the next day. And then you can sell into strength about 25 to 50% up 10%, especially if you're adopting more of a swing trade mindset day 1. And then you can trail the rest of the 10 EMA because the strongest gappers will respect this moving average. And this could be on a closing basis. This could be on an intraday basis. I like closing basis of the 10 EMA with these names because often, they're going to recover if they're being bidded up consistently by institutions. They're going to be bid up if they undercut that 10 EMA and continue that trend if they've been respecting it. If I'm entering day 3 plus, I typically just use my typical 20 EMA, typical swing trading sell rules to close it below as my sell rule. But entering day 1 or 2, it's more of a swing trade mindset, as I mentioned here. Routines for finding gappers. Like I mentioned, that post pre-market dashboard is really helpful in DFU. Then analyzing the catalyst, we've gone through that. Just setting a screen for significant gaps. We've got a lot of presets in DFU looking for big gaps. We've got a episodic pivot screen. We've got a screen that Roy Maddox, US investing champion or top performer, gave us gaps up over 10%. All of those are kind of looking for that same thing, strong gaps on volume. Then you want to set alerts at key levels, HVC. And then this is really important, as I mentioned a few times, keep an eye on recent gappers. And I like to keep a watch list of recent gaps because they're going to maybe form a post-gap range breakout or a base down the road. So don't drop the ball and let something go without you. Keep a watch list of that and then review it every single day. There won't be that many to keep track of. And this is something I do for TradeLab members is I keep a watch list here. I've been adding that to the report because we are in earnings season. And then you can review that and look for setups if they are occurring. All right. So this is really important, when to trade gappers, because every setup has its time and market environment where it's going to be more successful. Like I've said before, early in a new uptrend of the market as well as a stock, these are going to be more powerful. And basically we want a risk on environment. That's what's going to lead to good follow through after the initial gap up. So when breakouts and other gap ups are following through, that's when gappers are more likely to succeed. Earnings season, obviously, this is when gappers are occurring. And sometimes they can be the only trade on because maybe breakouts aren't following through or things are just kind of basing. And gappers are only real momentum in the market. So it may be obvious to trade these during earnings season, but that's just when to focus more on this setup. When there's a game-changing catalyst, obviously look to trade the gapper. It's best when the QQQ is above the 21 EMA. Again, this is just trying to see, are we on a risk-on environment or not? And then this is important, just like with breakouts, don't force gap buys in bad markets if they haven't been following through. If you haven't had good feedback recently with trades, trade smaller or maybe see if 1 or 2 work. They're more likely to be sold into in a choppy market, distributed market. So just keep an eye on that because institutions can use these for liquidity if the market environment is more going that way. All right. So the next section is I want to talk about an LMND trade. You may have seen my video early about my execution in this name on day one. This was a day one entry for me on the anchored VWAP reclaims. I want to talk about what went right. And then also I did get stopped out on Friday, basically at my cost basis, because I had a 13.5% cushion, raised my stop to break even. And then I was stopped on Friday, and then it went without me into the end of the day. So I'll talk about kind of some takeaways from this trade, maybe some things I'm going to change later on. And I wanted to share this because we've talked about a lot of gappers that just went and looked easy in hindsight. It looks so easy to just look back at these examples, and you enter here, you enter wherever on day one, and it works out. But in real time, things are going fast, and you want to stick to your rules and your process, and things don't always go to plan. For instance, day one, I had a very strong cushion going into the end of the day. I was expecting further momentum, but for whatever reason, whether it was the market kind of getting weaker or just this not being ready, it pulled in hard all the way to my cost basis, giving back the entire profit. So maybe I should have been more market sensitive, but I'll talk about a few of my takeaways and kind of my process with this name. But first, kind of getting into the entry tactics here for people who haven't watched that video. This was a gap out of a big base. LMND is a name that has made powerful moves in the past, so that was kind of an additional edge here. And it was gapping up on big volume in pre-market here of 14% with over that 10% threshold pre-market volume. So here is LMND. This is my focus for that day. Here are my entry points. This is a 1 minute chart. I'll probably link or send via email the full entry tactics video because I think it's well worth watching, even though this trade didn't work out because it was good execution on the buy side. It's more the sell side that maybe was the mistake on my part, or just simply the market, stopping me out as well. But basically I traded the anchored VWAP here and then added even more and heavier in both my Roth and my margin account at this point. Set my stop initially on this buy here at this low. And then as we reclaim the anchored VWAP again, so we pushed higher, formed a base, reclaimed the anchored VWAP here. Here my stop was here, and I adjusted all my stops to this level. So all my stops were at this point. And then LMND acted beautifully day one and just trended above that anchor VWAP. This is what it looked like at the close. This is a 5 minute chart. So here are my entries around the opening range. So again, I want to buy early in the session to profit from that expansion. I love how it trended above that anchor VWAP the whole day and based constructively right near highs into the end of the day. So everything looked great, picture perfect on day one. Then day two and day three happened. So the market got a little bit weaker. We failed to break out here and push lower. At this point, I'm still holding. Again, my plan for this name, because I looked at the past moves LMND had, I wanted to play a bigger move. So I was willing to give it back to my cost basis. That was my sell rule at this point. We pulled in. This is fine. Day two, we pulled in with the market and then constructively consolidated base into the end of the day. Day three is more where if I look back on this, I maybe could have made a change. The market continued lower and we broke lower below this base. And maybe I should have changed my plan, took in some off and waited for the post gap range breakout or another setup. And the reason being is the point of holding day two and day three is to benefit from quick reconfirmation. And the market gapping down and continuing lower day three, and this one breaking lower as well, kind of showed that that wasn't going to happen. So I could have taken that off and look to rebuy at a range breakout or another entry point. Now, obviously, this is all in hindsight, and you don't want to optimize too much your rules to any one example, especially when there's other factors with the market pulling in. So honestly, I don't think I'd change too much about this trade, even though it ended up being a break-even trade, giving back 13% cushion, and it rallied 8% without me. But I honored my rules, I earned my stop, I honored my plan, which is the goal. I just kind of want to think constructively, what could I have done better? Is there anything I should note down consistently? So if it happens a lot and I'm stopped at a lot and it goes without me, I can change that over time. And that's kind of my mindset with studying the setup and trying to improve with each time I trade it. So here's what it looked like on a daily chart. So this is where it stopped me out right near the low of the day. If you're not feeling stupid some of the time when you're trading, you're not managing risk. So this is my cost basis, stopped me out just above my cost. So technically it was like a 0.1% profit trade. So a great trade, but I would still be in it if I kept my original stop. So again, that's something I may be looking into. If I'm willing to hold for a bigger move, maybe I shouldn't have moved up my stop. Again, just something that I'm thinking out loud and sharing with you guys. And very strong close. At this point, it's starting to look like maybe a U-turn setup. And if it does an inside day or continues higher, this could be a post-gap range breakout. So I'm still watching this. I'm not discouraged by my first trade being a scratch trade. It still has all the characteristics, the edges, and I'm waiting for the next setup, and potentially that's a push through this high. So I will be watching this early next week for an entry. But you've got the market, potentially being a factor as well. And gappers, again, are market sensitive. So we'll see if we continue higher after Friday's upside reversal. These are all things I'm just kind of thinking about in my mind. So some trade takeaways. Again, I think it was a really good trade execution buy point on my side. It's more the sell rules that maybe are room for improvement later on. So should I have sold a quarter up 10%? More of a swing trade mentality. I could have sold a quarter, 50% of my position, and then kept my stop where it was and kind of free roll that trade, as a lot of people say. That could be more of a swing trade mentality, and then look to add it as it did a post-gap range breakout or something like that. That's a possibility. I'll be thinking about that. Then just these are my raw thoughts. Earnings moves are market sensitive. Potentially sell some on break below the end of the day one base on that day two. Pervasive market weakness on open day three. Everything was pulling in. I could have sold more or more of my position on a break below the day two low. And then the goal of, I already talked about this, the goal of holding through day 2-3 is to ride that reconfirmation. The open day 3 showed that it was unlikely as we failed to rally off the open. Because if we go back to the chart here, you can see we opened lower, tried to push higher, and then were rejected down. So at that point, I could have made a judgment call. Hey, the rally failed. I'll take some off or all my position off. Could have taken off and looked back to reload intraday or on post-gap range breakout. So these are just raw thoughts that I'm collecting in my journal to potentially get better at trading these earnings gaps. And I wanted to share this example because this is what real trading is like. I'm always improving at my setup. I'm trying to get better every time I trade it. And we just want to slowly get better over time. And taking careful notes, and I've got screenshots of kind of my progression through this trade and my notes in real time in my journal. That's what's going to make me an expert of this setup and continue to build my expertise in it over 10, 20 years. I'll get so many more examples, so many improvements, small tweaks to make, so I can really get fantastic at the earnings gap setup. So just want to share this with you because of my thought process, but also to show that earnings gaps don't always just work perfectly like we've shown in the other examples. There's going to be pullbacks. It's going to be tough to position sometimes, and it takes some creativity a lot of the time. So want to share what a real trade looks like, and not necessarily a failed one, but a scratch trade. Here is the 15-minute chart kind of showing all the markups here. This is where I stopped out literally on this bar right here as we broke lower, and then we rallied that 8% into the close. So it doesn't feel great, but it's all good. And then this is the HVC level marked up here. So we're basically basing between a support level, which is the opening range. A lot of volume is here, so volume support here, and between the HVC. So still setting up for a post-gap range breakout through this level. And we're lining up here right near the anchor VWAPs at this point. So we're pretty coiled into the end of the week here. So we'll see what happens next week. This will be interesting to watch. And then here I've got the QQQ showing the pullback. This is the gap down and continuation lower where I could have made a judgment call and taken some off before it hit my stop. But again, hindsight, always 2020, just trying to collect information over time and share with you a trade of an earnings gap. Okay, so key reminders from today. Gappers are a cyclical but powerful setup that yields high momentum moves. Gappers can fail quickly. Always manage risk. Manage risk tightly. Managing risk is so important. I say it twice. Manage risk tightly and logically look to right expansion. Gaps can kickstart duration moves. So again, they can just be the very start of a market leader move. The catalyst must be significant. It must change the company's prospects. That's key and what we're looking for with that AI prompt. Use quick entry tactics. Expect to be stopped out a few times, especially as you're kind of improving your execution. And the best gappers trend all day above their anchor VWAPs. I've made that observation a ton, and it's something that lasts quite a while. So that's pretty much it for today. Just one ask for you guys: if you found this webinar helpful, please go ahead and scan this QR code. Give me some feedback. I'd really appreciate it. So again, it just takes a few seconds, and hopefully you've learned a lot today. If you have any key takeaways, let me know in the chat here. And I'd love to hear your thoughts, your biggest aha moment. If you had one today, drop it in the chat. And if you wouldn't mind, it would just take a few seconds again, scan this QR code and give me some feedback. And I'll be happy to answer a bunch of questions today if you guys have any. All right. Tom says a lot of aha moments today for me. Awesome. Just as said, similar thing happens to me with STX, just market environment factor at the moment. Great presentation, 100%. And good point, Joseph. Again, these are market sensitive setups. Follow through with breakouts is market sensitive. Gaps following through is market sensitive. All right. Let's see any questions. Jonathan says LMND also a high float short, which could squeeze it 100%. So that's going to make a day one move and reconfirmation more powerful because it's another kind of edge characteristic that adds fuel to the fire and makes that setup that much better, right? I see some question about the Trade Lab. That's my newsletter, educational service. I'll probably send out an email about it as well. There'll be a great Black Friday deal. I've got some really cool courses I'm adding that are included in the Trade Lab, as well as a momentum boot camp early next year that is included. So I'll send out more information about the Trade Lab shortly. We'll have that Black Friday offer pretty soon. Let's see here. Kevin asked, Richard, on day 2, is there MA that you're watching for price to touch and then bounce off of 3 or 5 EMA? No, day 2 plus, I'm not really watching for the 10 EMA. I watched day 3 plus, but day 2, the MAs are going to be so much below price that they're not really significant. So it's more the anchored VWAPs that are key levels I'm watching day 2, day 3 plus. Okay. All right. Awesome. Let's see if there's any other questions. But when and how do you decide on your entry strategy? I pretty much am always going to use the anchored VWAP reclaim entry tactic on day 1. And then if I miss that or it's not there, I'm probably going to wait for a post gap range breakout. That's kind of my bread and butter. I love range breakouts. If you don't know that about me just yet, I love trading those range breakouts. From contraction on a daily chart comes expansion. So that's pretty much my preferred way to trade gaps. But day 1, I'm pretty much using the anchored VWAP reclaim. And then I'm setting my share price or how many shares I'm buying, my anticipated stop. All that is before the market opens. So I've got my plan set before the market opens. And preparation for these type of trades is so critical because, again, things are going to be moving. That's why you're focusing on only 1 or 2 stocks. Really, 1 stock is preferred during the market open, because then you can really focus on that price action and put everything else aside. Just focus on, does it meet your entry criteria, and just try to get good execution on that setup. Yeah, I'll share my DVU screen and probably make a video about that pretty soon. All right, cool. All right, well, thank you guys all for joining me. Again, if you haven't left feedback, please go ahead and do so. I'd really appreciate it. Helps me get better at all the webinars that I do. I'll probably do one on pullbacks in the coming weeks. For TradeLab members, I'll be doing a earnings gap related model book case study webinar, so stay on the lookout for that. Again, if you haven't left feedback, please do. Please leave a like on this stream if you enjoyed. Subscribe if you're new to the channel, and I'll see you guys in future videos and webinars. Thanks so much for tuning in, and have a great rest of your weekend. Cheers, everybody. Bye.